Greetings, everyone, again. I hope everyone had a wonderful Thanksgiving, even though I'm sure the group was a little smaller than normal. Hopefully it was great bonding time with family. I don't know if this is the last one I'll do this year, the last of these videos, but it is Employment Day, so we decided to do one today. And so the normal drill, monetary policy, fiscal policy, the economy, market indicators, and then a few words on our favorite subject at ARK, innovation. Okay, starting with monetary policy, M2 is still up 25% year over year. It's pretty astonishing. Now, obviously, the economy is not up 25% year over year. So that means velocity, or the rate at which money turns over, is falling fairly dramatically. Now, if velocity were to stop falling, and there are two reasons we think it could, then the economy that we're seeing, which is very strong, talk about a V-shaped recovery, would move into overdrive. The two reasons velocity tends to stop falling, one is very good and one is not so good. The very good one is when confidence in the economy, both businesses and consumers, is rising and very high. So it has been rising, both of them have been rising, but they're not at all-time highs yet. The second reason velocity often turns, and I saw this when I started in my career, it was toward the end of the 70s when inflation was a problem. And when inflation and interest rates start moving up, the velocity of money stops going down and actually can turn around and start moving up, which adds even more firepower to monetary growth. Now, we don't think inflation is going to be a problem. We do think a lot more people are going to be talking about it. And there are reasons to worry to some extent, but we think the productivity gains coming out of the explosive innovation we're seeing today are going to overcome some of the problematic inflationary indicators we will see during the next year or so. On the fiscal policy side, we got an employment report today, which was worse than expected. And so that seems to be motivating more policymakers to pass a fiscal policy package. So we do think that will occur, and it's a good thing. We're seeing a lot of turmoil and distress in certainly the retail and other services areas. I just went to our local restaurant here this week, and I could see the fear in the eyes of the owner as business was drying up again now that the coronavirus is surging again. So he certainly needs some help. In terms of the election and implications for fiscal policy, we still believe we're going to be facing somewhat of a gridlock situation. I know that a lot depends on what happens in Georgia on January 5th. We think at least one of the two Republicans running for Senate will get elected, and therefore the Senate will hold, the Republicans will hold majority in the Senate by a thread. What we're also seeing, though, in the House is, I think, more Republicans have won than anyone anticipated. I think the difference between, or the number of Democrats and the number of Republicans in the House is down to 10 or 11, if I'm not mistaken. And we do believe that Joe Biden might be able to bring along some Democrats, or I should say the Republicans might be able to bring along some Democrats to their point of view about some pieces of legislation moving forward. And so we might actually see a little better than gridlock in terms of policymaking. And it probably will have more of a conservative tilt than I think many are expecting, especially because Joe Biden won the election. So on the economy, well, it's been on fire, whether we're talking about consumption, housing, capital spending, even trade has picked up fairly dramatically. And so we are, I'm just one sec, I'm gonna hang up. We are always on the lookout for, okay, what next? And today's employment report gave us a lot of information. But before I go there, I'd like to talk about one thing that has changed relative to our expectations before and relative to uh, uh, the trends that were in place in the last 6 months. Inventories have started building again. That's a big difference. And as I mentioned on many of these calls, for months now, businesses have been scrambling, particularly on the durable and non-durable side. They've been scrambling to keep up with demand. Well, they are beginning to catch up so that now we're seeing inventory increases. Now, that's not a bad thing. We need inventories to keep up with final sales growth, but that is a change. And so the certainty of a V-shaped recovery that was born out of this idea that the businesses were scrambling to keep up with consumers, that is no longer the case. What would make that the case once again is an extremely strong holiday season. And I think we're going to see that. There are a few metrics we can use already. JP Morgan just today reported that its credit card growth was up 15% over the Black Friday, Cyber Monday long weekend. That is an extremely strong number, up 15%. If you look at the S&P 500, you take the average for September and see where we are now, we're up about 9%. And typically retail sales follow that number. So 9% up from the September average. Again, that would be an extremely strong holiday season. And so the signs are good. In the employment report today, we did get a few weak spots. First of all, the entire report was weaker than expected, with non-farm payroll employment up 245,000. Expectations were 460,000. More important to us was household employment, which includes many more small businesses, was actually down, I think, roughly 70 to 77,000, somewhere in that range. So an actual decline in the broader measure of employment. The unemployment rate did tick down 0.2, but that's because the labor force shrunk. So that probably means that there are more people not looking for jobs, maybe because we're approaching the holiday season. And I should say more people than normal not looking for holiday jobs, because this statistic is seasonally adjusted. The weak areas within the report were retail, and I think we understand that with the resurgence of the coronavirus and the restrictions now being placed on restaurants and other retail establishments. Tech was flat, and that's very interesting to us. It could be that productivity is increasing in the tech sector itself because of the digitalization of everything. And government spending was the biggest weak spot. Now, many state and local governments are not allowed to run deficits, and so they've had no choice but to lay off people. So that is an issue. There may be in the fiscal package some shoring up, although not nearly as much as many in Congress wanted, a little shoring up of the hardest hit state and local governments. The other weak spot in the employment report was a significant drop in the manufacturing work week, a 0.5% drop, or 0.2 hours. I pay a lot of attention to that, and it goes back to that inventory discussion. If inventories are now keeping up with final demand, then this notion that manufacturers have to scramble to catch up with final demand, that no longer is the case. And so that's probably explains why the manufacturing work week went down. The positive part of the report was average weekly earnings on a year-over-year basis. Its growth rate, or their growth rate, accelerated from 5.6% to 5.9%. The other thing which I didn't mention earlier, but which is still true, is the saving rate is still high. So with the October report, we saw that the saving rate dropped to 13.6%. But again, very high by historical standards. It was roughly 8% before we headed into the coronavirus crisis. And so it means that the consumer still has more firepower. As many people have noted, consumers are not taking big trips for Thanksgiving and the holidays this year. And therefore, they have that much more in spending power elsewhere. So that's another buttress to consumption. And we also got today the durable goods report, which is reinforcing the surge in capital spending that is underway. And we think a lot of that surge has to do with the digitization of the global economy. I mean, it's much more profound than I believe even we expected at the beginning of the coronavirus. And I'll give you a few company examples of that later on. As far as market indicators, well, the commodity with the PhD, that would be copper. Just have to hang this thing up again. The commodity with the PhD, so that's copper, that has broken out. It's broken out to the upside in an absolute sense, and it has broken out relative to gold. So that is a big cyclical indicator. One of the reasons it may be breaking out is that the dollar is breaking down. And that means two things. I mentioned some inflation indicators may be pointing in the wrong direction. The dollar would be one of those. The declining dollar also does a good thing at least from an optical point of view, and that is it bolsters earnings, S&P earnings, US earnings. And so there are two impacts there we're focused on. As far as interest rates, well, I think we're seeing a turn in long-term interest rates. According to technicians, and take it for what it's worth, but if the long-term treasury bond yield, so this is the 10-year, and it's in the low 90s right now, if it were to move above 1, many of those who watch the long rates very carefully would say it's a straight shot to 1.5 then. So for fixed income investors, that would be problematic. For equity investors, I do not believe it would be problematic because the asset allocation shift from fixed income to equity is still long overdue, despite how well the equity market has done. It has done this well with equities being in a net outflow mode here in the United States as measured by ETFs and mutual funds. The outflows since early 2018, so right after 2017 when the stock market had a very big run, and we thought that would be very positive for flows. Well, equities continued to outflow, and since then they have outflowed by more than $400 billion. And that does not include share repurchases that corporations are doing. So continued outflows. I think just very recently we've seen some inflows. In contrast, on the fixed income side, we've seen inflows of more than 800 billion. So that's a $1.2 trillion difference there. Many people ask me if we're in a bubble. for equities. And I say, I don't believe we'll be in a bubble until, first of all, we see net inflows and probably the flipping of the relationship I just described. So fixed income net outflows to the tune of 800 billion, or I'm sorry, 400 billion, and equity inflows to the tune of 800 billion. Now, it's probably not going to be that extreme, but I'm just trying to make the point. I don't think we're in a bubble. There is one indicator that gives me pause. And while I do not believe we're in a bubble, sentiment indicators for the equity market in particular. So this would be the bull-bear ratios or the American, I don't know if it's AAII, American Academy of Individual Investors. That indicator is out to very high levels. And typically, when it gets to very high positive readings, we are going to have a correction. Now, not always, not always. As I mentioned, not a lot of other indicators seem to be in bubble territory, but I wouldn't be surprised to see some sort of correction after this seasonally strong period that we're in. That said, as I mentioned, I think we've got a long way to go in the equity market. Now, finally, some words on innovation. Well, I think what has excited us the most during the last month is something that just happened in the last week or so. DeepMind, which is owned by Alphabet or Google, had an artificial intelligence, deep learning neural network breakthrough called AlphaFold. AlphaFold is being applied to the genomic space and is helping researchers understand protein folding. Protein folding and just the structural shape of proteins are very important in terms of drug discovery. And to give you a sense of what has just happened and how it's going to collapse the cost of a lot of research in healthcare and explode the knowledge base and the understanding of how the human genome works. It used to take, to discover the structure of a protein and understand it, it took anywhere from $100,000 to $1 million per protein structure. Now, there we have, I think we now understand the structure of something like 150 to 200,000 proteins, but there are roughly 170 million proteins out there, and that includes in plants and animals as well as human beings. Because of this breakthrough, because of DeepMind's breakthrough, we think that $100,000 to $1 million per protein structure is going to collapse to pennies. Provocative. It's one of the most provocative improvements we've ever seen in artificial intelligence, and the accuracy of these protein structures as determined by AlphaFold is more than 90%. It's a 70% improvement from 2 years ago. We didn't think we would see this for another 6 years. So something has changed here. And what we believe it is really brings the human being back into the equation in a very important way. So as you know, deep learning, that improvement took most of the human programming out of the deep learning equation or out of the artificial intelligence equation. Human programmers cannot conceive all of the potential permutations of any problem out there in terms of trying to solve it. But machines, when you throw huge amounts of data with iterative algorithms and huge amounts of computing power, machines can get to the right answer. Now, what I think we've learned from AlphaFold is the secret sauce in getting the machine there faster than the extra 6 years we expected was the domain expertise of the researchers, the biologists, who were setting the goals or the reward system for the machines to reach. And so that domain expertise has become the secret sauce. So importantly, while many people think that human beings are going to be dealt out of the equation, so to speak, that is not true. The winners in many winner-take-most categories, and we think molecular diagnostic testing is one of those, as you know, within Vitae leading the charge, we believe there. There are going to be many, and they're going to have domain expertise really guiding the artificial intelligence to the right goals. So that was very exciting. The other thing I think we have learned from earnings reports even this week are that the equivalent of over-the-air software updates. You've heard us talk about this when it comes to Tesla quite a bit. So Tesla is still the only auto manufacturer, I believe, maybe someone else is on the scene with it, but I haven't seen it, which can anticipate an auto's problems and correct those problems with over-the-air software updates, even before the owner of the vehicle understands there's a problem. I've mentioned on a number of these videos that I have not taken my Model 3 into the shop, or I guess that doesn't happen with Tesla. They come to the house, but because nothing has gone wrong. The only thing that did go wrong, which over-the-air software updates could not fix, was a nail in the tire, a flat tire. But other than that, nothing. And I'm beginning to believe that that this idea of over-the-air software updates is helping to anticipate problems and solve them before they occur. Two companies this week reported that reminded me that this could be a much broader concept applied to many more industries as we digitize the physical world. PagerDuty, very few people know the name of that company. They're an enabler in terms of digitizing operations in business. And it seems as though one of the reasons they are experiencing a bit of a breakout now is that they too are anticipating problems that are going on in the digital operations of any company. They can, with artificial intelligence, have a good idea of when a problem is evolving, and that they can anticipate it and get in there and solve it or alert businesses ahead of time. So huge productivity increase. And a little bit off that path, but there is some similarity to it, is DocuSign. And that company, as we all know, the electronic signature, the digital signature, they are now creating an agreement cloud. So before you sign an agreement and after you sign agreement, there are procedures and processes, and there are checks and balances, and there's confirmation. They want to be involved in all of that so that they can do the same thing, anticipate issues before they arise and be part of the solution. So that's a little further out, but it is a theme that is recurring. So we are on the lookout for those. And then finally, what I'd like to talk about is Bitcoin. Bitcoin has had a magnificent run this year. It got down below 4,000 in March during the coronavirus crisis. And we know very well, went through a lot of growing pains in that time, and I think is better for it. And I mean the entire ecosystem, including the exchanges that at one time allowed 100 times leverage. I don't know if that's still going on, but those who were 100 times levered in March, they no longer have their businesses. So I think governance is becoming better in this space, which is all to the good. We have written 2 white papers, specifically Yassine El-Mandra, our crypto analyst, has, and one of them examines whether institutions are ready for Bitcoin, and also asks the other question, is Bitcoin ready for institutions? And we think one of the reasons that Bitcoin is appreciating is institutions are dipping their toes in. Now, they're doing this not just from an investment point of view, but from a corporate cash point of view. Some of you may know that MicroStrategy has converted all of its cash, the cash on its balance sheet, into Bitcoin. Square has done that with, I believe it's 5% of its 1% of its assets, 2% of its cash. And I believe we're going to see other companies doing that as well. We know that PayPal also announced, so it is following Square and Robinhood and allowing the purchase and sale of Bitcoin. PayPal is, a much more conservative, more old world company than either Square or Robinhood. So again, some validation there, seal of approval of sorts. And the paper that Yassine wrote describes what would happen if institutions decide that a 5% allocation to Bitcoin is appropriate. And the reason, and really that number is closer to the 6% range, the way we wrote the paper. But the reason 5% is important to me is I saw real estate entering pension funds in the 70s, and they started with 1%, migrated to 5%. We saw emerging markets, many pension funds and institutional investors moving into emerging markets as MSCI developed that classification and moved from 1% to 5% and wherever they are now. And we think the same thing is going to happen with Bitcoin and other cryptocurrencies. And if it does, and if it's, say, just with Bitcoin, and we've got that 5% allocation, somewhere in the 4 to 6% range, that if that were to happen and all institutions were going to do it, of course, that's not going to happen, but some might add more, so offsetting those who don't participate at all. That would add somewhere between 400,000 and 500,000 to the Bitcoin price. We're at 20,000 right now. Now, that is not going to happen tomorrow. It's not going to happen for years. But if we're on our way, it is going to be a very pleasant journey. So with that, I'd like to talk about 2 things that we're up to at ARK. Our analysts and Brett Winton, our director of research, are working feverishly with our marketing team to get our big ideas ready for release in January. And within the next few weeks, Sebastian Benkert is our chief marketing officer, will have for us the best of 2020 ARK podcasts. So look out for those 2 things. Bitcoin, the Big Ideas Report will be a January event. The best of 2020 will be later this month. And with that, I don't know if I'll be speaking with you again. If there's something very serious that we need to address, we will do that. In the meantime, if there's not anything to address, anything really important to address, we wish you a wonderful holiday with your family. And we thank you so much for tuning in and supporting ARK Invest. Thank you so much.